In this video, we're going to be talking about the VIX, the CBOE, breaking down the huge spike that we've seen from the tech sell-off, the exact opportunities behind the VIX, how we can take advantage of this, and ultimately what is behind the tech sell-off. If you like these videos about the market, then make sure we hit like and subscribe. Stay tuned.
Tech in particular got hit hard, which is interesting in the light of the fact that the NASDAQ is down pretty sharply as well.
It was certainly a lot of red out there. We have the S&P 500 down more than 3%, the NASDAQ 100 sharply lower.
So first of all, let's talk about the markets. We've got the NASDAQ. It's down 14% off of its highs. Now, there is lots of different reasons behind this and the thought process of why the market is selling off. Naturally, we've had a big rally in tech anyway this year, and the markets are doing very well in general. We're seeing a huge sell-off, and this is happening rather aggressively. Warren Buffett has halved his position in Berkshire Hathaway in Apple shares. So reducing his position by half has sort of brought a bit of an attention to the tech sector. Why is Warren Buffett, one of the best investors in the world, reducing his position by half in Apple? So that's one of the first questions that we've seen coming around the tech sector. With US traders focused around the US economic growth risks of the economy, we are starting to see other countries such as the UK start to reduce their interest rates. The Federal Reserve held off of reducing their interest rates. However, we're definitely going to start seeing them fast forward that approach of reducing interest rates, especially when we're seeing these sort of stresses in the market and the overall fear of growth within the US. So this will be time when we start seeing the Federal Reserve reduce those interest rates, which will overall help the economy. The NASDAQ 100 saw its worst start to the month since 2008. Absolutely crazy. And the Volatility Index, known as the VIX, had one of the biggest spikes in the last 10 years, which is absolutely crazy when we look at it like that. Are these fears going to continue throughout the week? I suspect so, and I'm going to tell you exactly why. We're seeing heightened tensions between Israel and Iran now. Israel took out two of the top political leaders of Hamas. Iran is saying that this needs to be retaliated to stop further conflict, which I think is rather insane to see that. And we're seeing rockets coming from Lebanon into Israel, and we're seeing this sort of heightened alert around conflict. Now, with this in mind, not only do we have potential war conflict when Iran starts talking about attacking Israel, that is then obviously backed and protected by the US, which means they have involvement, and on Iran's side they obviously have heavy relations with Russia. So you can see how this can quickly unfold into a global conflict if not taken seriously between political leaders very quickly. With all of this going on, there is a sense of heightened volatility, a lot of fears coming into the equities market. We're seeing the yen trade become stronger, meaning everybody's turning towards the Japanese yen now for a safe haven. And so you're seeing US dollar against the Japanese yen completely sell off and creating a fantastic trade. I am short on US dollar against the Japanese yen. And this is obviously heightened with the fact that the BOJ is increasing interest rates, whilst now the Federal Reserve is going to be looking to decrease their interest rates. And so we get that double whammy there on interest rates. US is cutting, yen is putting it up, yen is seen as the safe haven, and so therefore we're going to see the US dollar against the Japanese continue to fall, at least within the short term and potentially mid-term, based on all these conflicts that are happening. Now, depending on how deep the equities market sell-off goes, and depending on what Iran's reaction is back towards Israel, depends on how much we're going to see the volatility index spike and increase. At this moment, the tech sell-off is catching momentum. We are seeing the VIX sit at heightened levels of where there is a potential opportunity here. So let's break down the VIX. I'm going to pull up the chart and we're going to run through the VIX. So the Volatility Index, also known as the fear gauge, is a great tool for traders to be able to look at, to be able to gauge where the market is going in regards to S&P 500 options. Now, what this does is usually correlation between the two. When the S&P drops, you'll usually see that the VIX rallies. But it's more than that. It's more of a future outlook of what the stock market is doing, and therefore this is very focused around fear within the market. So things that would spike this would be huge sell-offs within the stock market, large terrorist threats such as Iran at this moment in time. You can also see the market spiked quite aggressively when Russia invaded Ukraine and COVID. These are great examples of it. But the easiest way to explain this is that the volatility never usually remains elevated for a prolonged period of time, unless the volatility deepens in a very volatile way. For example, COVID got progressively worse. So it has to stay at an elevated level in order to keep the fear index high. Now, when we look at this, you can see how we saw this initial shock up here from the tech sell-off. Those fears coming into the US economy from a growth aspect, and at the same time, the retaliation, the deaths of the political leaders of Hamas with the rebel group within Lebanon attacking Israel with rockets, and then this whole thing escalating over the weekend. So we've now seen this heavily increase. We saw this initially spike on the VIX futures, which is what we're looking at here, spiked all the way up to 37. Now, we haven't seen these levels since back after, this is the COVID one, absolutely insane seeing that spike. But this is the volatility around how the world was digesting what Russia was doing, the different sanctions, how the progress was going within the war. And it has majority tailed off from that period. Now, personally, I'm of two minds here. I want to join this market and short this because I know that volatility won't last for a prolonged period of time. Now, with the NASDAQ, we're down roughly 13-14% off of the highs. Now, a 20% drop would mean that we're in a bear market and there's a correction that's taken place. Could we see an additional 6% drop on the NASDAQ? Potentially, I think so. I think we're seeing that going into elections as well. Obviously, Joe Biden dropping out the race. There is a little bit of political uncertainty, but I think that Trump is probably going to pull it out of the bag. So I do naturally see that we have that drop from the instability around the economic growth, the political future. Obviously, the Fed didn't cut rates like the UK, and now obviously that's going to be looking to be happening very quickly, I would say, within the US, and I think that they'll be jumping on that on the next rate cut, and I think that will definitely happen. So will we see heightened volatility? This definitely, I think, is something that could pan out this week, and I think we could see that increased volatility. Just whether or not do I want to short now or wait until we potentially hit 30 or 35. Now, for me, it's going to be a waiting game. I generally believe on waiting on this, and I'll be looking to short if we see 30 to 35 again. Volatility, as you can see historically, does not stay heightened, so it may take a week or two for it to come down, but this is a very quick way to progressively make good gains. So if we come back down to the average of say 15, 16, then we're looking at a 45% return on our position. It could be a huge opportunity here to take advantage of on the volatility index. These spikes don't happen often, so when they do, we want to take full advantage of it. Just like this one, we knew that COVID wasn't going to last forever, and therefore taking a short position for a reversion to mean trade on volatility would be a natural position to take. So the VIX will usually sit, as you can see, bouncing around off of these lows here, down here, from around 12 onwards. Anywhere between sort of 10, 12 is sort of like where we're in the happiest state of the markets. There is no fear, the world is moving fine, the economy is growing, there isn't huge tech sell-offs, okay? Then we'll sit roughly between 15 to 16 with low to moderate volatility. Again, nothing too concerning, but as soon as things start coming into questions where we get these huge spikes up, these are the areas where we want to take advantage. Predominantly, this will be above that 30 level, knowing that these are heightened levels. The question is how deep is this going to go? Could it go to 40? Could it go to 50? Could this be an all-out recession crash and us witness 50 or 60? So this all comes down to your risk management. How deep are your pockets and what does your position look like? Ultimately, for me, this is one of the only things that I would trade where I would add to a position as it increases, because the likelihood of it maintaining above that level for a sustained period of time is highly unlikely. and also how you can implement this into your whole portfolio from a strategy perspective. And so you can use this from different aspects, not only from a speculation point of view, from making money on this from an individual level, but also if you wanted to offset and hedge against an equity drop on your overall portfolio. That is traditionally what a lot of traders use the VIX for. They use this as a hedging tool to offset their equity drops when we see these large sell-offs, but also more frequently, a lot of traders are using this for speculation, so taking advantage of this opportunity that doesn't happen too frequently. Get in the comments, let me know what you think about the VIX, give this video a thumbs up if you've enjoyed it, and most importantly, check out the description for VIX strategy and see exactly how I trade this sort of position.